Delivering growth or risk, unpacking the Shadowfax IPO. Welcome back, listeners, to another deep dive into the stories shaping our markets and our future. Today, we are turning our attention to India's buzzing IPO scene with a company that's literally delivering on the e-commerce boom, Shadowfax Technologies. This logistics player is gearing up for a blockbuster public offering, aiming to raise over 900 crore. But as the hype builds, the big question looms: is Shadowfax a high-growth gem for investors or a risky package that might not deliver the returns? Let's unpack this story together. First, let's set the stage. Shadowfax isn't some overnight startup riding the e-commerce wave. Founded in 2015 by a group of sharp IIT alumni, this company has carved out a serious niche as a third-party logistics provider, or 3PL liters, as it's known in the biz. They handle everything from express parcel delivery to hyperlocal logistics, partnering with some of India's biggest digital platforms. Think major online marketplaces, quick commerce apps, and on-demand delivery services. If you've ordered something online in India recently, there's a decent chance Shadowfax played a role in getting it to your doorstep. Their scale is impressive: over 53 sorting centers, 3.5 million square feet of warehouse space, and a network touching more than 14,700 PIN codes across the country. That's the kind of infrastructure that positions them as a key player in India's rapidly expanding online economy. Now, the numbers behind this IPO are eye-catching. Shadowfax is looking to raise 1,000 crore rupees in fresh capital, with the rest coming from existing shareholders selling their stakes. At the upper end of the price band, the company's market cap could exceed 100 crore. That fresh cash? It's earmarked for capital expenditure, acquisitions, lease payments, and general corporate needs. On paper, this looks like a company ready to double down on growth. And the growth story is real. Shipment volumes have surged at a compound annual rate of nearly 30% between fiscal years 2023 and 2025. With over 43 crore shipments handled last year alone. Revenue is soaring too, hitting ₹806 crore in the first half of fiscal 2026, a staggering 68% jump year-over-year. That's the kind of momentum that gets investors excited. But here's where we need to slow down and look under the hood. The logistics sector, while full of opportunity, is a notoriously tough space to make a consistent profit. Shadowfax has historically struggled with thin margins, a common pain point in this industry. The good news? They've turned a corner recently, with EBITDA margins moving into positive territory and even posting a profit after tax in fiscal 2025 and the first half of 2026. Management credits this to smarter cost management, better unit economics, and a focus on higher margin clients like direct-to-consumer brands and SMEs. But let's not pop the champagne just yet. Costs like partner expenses and transportation still eat up a huge chunk of revenue. Lost shipments, while not a crisis, are creeping up as volumes grow. And any hiccup in operational efficiency could send those hard-won margin gains tumbling. Then there's the bigger picture: India's logistics market itself. Valued at around $36 billion and growing at 8 to 10% annually, it's a goldmine of potential, fueled by the rise of quick commerce, changing consumer habits, and supportive policies like the National Logistics Policy. Online retail penetration in India is still under 10%, meaning there's a long runway for growth. Shadowfax seems well placed to ride this wave. But the road isn't without bumps. New labor codes set to kick in by April 2026 could jack up costs for companies like Shadowfax that rely heavily on gig workers. And here's a red flag: nearly half of their revenue comes from a single client. Yes, they've diversified over time, but that kind of concentration is a vulnerability. If that key client pulls back or squeezes pricing, the financial impact could be significant. Let's talk competition, because this space is heating up fast. Big e-commerce players are increasingly building their own logistics arms, and some are even opening those services to third-party customers. That's a direct threat to companies like Shadowfax, potentially sparking a price war that could erode margins across the board. When you stack Shadowfax up against listed peers, their valuation, at about 2 times estimated fiscal 2026 sales, looks reasonable compared to some. But it's still baking in a lot of optimism about future growth and profitability. In other words, Investors are paying a premium for a story that assumes everything goes right. And in a sector this cutthroat, that's a risky bet. So what's the takeaway for investors tuning in? Shadowfax offers a compelling narrative. They've got the infrastructure, the volume growth, and the tailwinds of India's e-commerce explosion behind them. For those with a high risk tolerance and a long-term view on digital commerce, this IPO could be a chance to get in on a growing platform. But for more cautious folks, there are plenty of reasons to hesitate. The valuation feels stretched. The margins are still fragile, regulatory risks loom, and competition isn't going away. Client concentration adds another layer of uncertainty. This isn't just about whether Shadowfax can grow, it's about whether they can grow profitably and sustainably in an environment that's getting tougher by the day. As I see it, this IPO is a bit like a high-speed delivery. It's exciting, it's got momentum, but you've got to check the package carefully before signing for it. Are the risks worth the potential reward? That's the question every investor needs to wrestle with. For now, Shadowfax is a fascinating story in India's evolving market landscape, but whether it's a blockbuster or a cautionary tale remains to be seen. Stick with us as we keep tracking this one and plenty of other market movers in the days ahead. Until next time, keep questioning, keep investing, and keep listening.